mom and pop, motivated seller financing. These are all things that we've done now in the last, 2 months, our last 2 deals that we closed. It's coming back. And that first deal was great, but it was a challenging deal. It was weekly renters. It was an older build, a lot of deferred maintenance, no systems, and we cut our teeth on it. We still own the property to this day. It's an amazing deal.
If you're an active real estate investor and you're looking to do larger deals, you're in the right place. We are going to go and take the conceptual type of stuff that you listen to from other real estate podcasts and bring it down to the tactical, the nitty gritty, the actual actionable types of things that other real estate investors that went big did to grow their own real estate empire. You're listening to the Go Big Live podcast. I'm your host, Matt Druin. Hey everyone, welcome to the Go Big Live Real Estate Podcast. I'm your host, Matt Druin, and I have an absolute beast in today, Mr. Gino Barbaro of Jake and Gino. That's how I've known him for years. Didn't know how to pronounce his last name. I had to verify. And I was like, I went on YouTube yesterday because it's always Jake and Gino. And I went on YouTube and looked up Gino Barbaro, and I found a YouTube video of him doing a instructional video on penny vodka. Okay, so you can start in real estate and go into big deals, and you don't have to, you're not born for this. I wasn't born for it either. But anyways, Gino is an absolute powerhouse in the world of multifamily and commercial real estate, with a portfolio of over 2,000 multifamily units and $250 million in assets under management. Gino is an incredible resource for listeners with a wealth of experience to share. As a best-selling author, entrepreneur, and co-founder of Jake and Gino, Gino has helped countless investors succeed in the world of real estate. Through his multifamily real estate education community, courses, books, and podcasts, Gino and his partner have empowered their students to close 60,000 plus units and have $4 billion in deal volume. So, Gino, thank you so much for being on the show today.
Matt, thank you. And it's Jake and Gino because Jake and Gino sounds better than Gino and Jake. My kids always ask me that. Why is it Jake and Gino? Because Jake and Gino sounds great. It rolls off the tongue. Gino and Jake, it's a little clumsy there. So for those of you out there wondering, that's why it's Jake and Gino.
Well, yeah, guys' names are tough, man. I'm expecting we're expecting a baby boy in September. We have a girl right now. She's 3 years old. She's still my baby though, and I can't, for the life of me, figure out a name with my wife for this kid. We come up with tons of different girls' names, that sort of thing. But it's so tough, man. So Jake and Gino are definitely on my list. I'm not sure if they're on my wife's list. So
well, I'll give you some help here. I got 5 daughters. So my 5 daughters, very easy names: Gabriella, Sophia, Veronica, Cecilia, and Laura. My son's name, Michael. I mean, plain Jane vanilla. I got all these beautiful Italian flowing names, and then I got Michael, right? But Michael's is just an awesome name. Andrew, love Thomas. I mean, honestly, Matt Jr., that sounds pretty good to me as well.
Can't do a junior.
No, I feel your pain. Gino Jr., same kind of thing, bro. I know.
So I like to start the show with out at a high level, you were born and now you're here. What happened in between?
How much time we got? I mean, I'm not a young spring chicken anymore. I mean, I've had a lot of things go on. My parents were immigrants, and I think that's the defining characteristic of what my life has been for the last 50 years. They came over. They came to this great country. They worked their butts off. My dad opened up a small restaurant back in the 70s and 80s, and it was a great middle-class lifestyle. That's back then when you had a small mom and pop, you could really make significant money and have a great lifestyle. And I fell into that. I went to college with that hard work ethic, what Jake likes to call it the blue-collar work ethic, and we opened the restaurant back in 1994. For the first 15 years, it was great. There was no Grubhub. There was nothing. I mean, there was no deliveries. It was just people coming in, waiting 45 minutes, sitting down. It seemed as if 2008 comes, my father passes away in 2007. 2008 comes, all of a sudden you have Paneras, you have people delivering. People can't wait 10 minutes to sit down. Things completely changed. It felt like to me. That's when the internet started taking hold, and we weren't ready for the change. And I said to myself, I need to be doing something else. My mom owns this restaurant. She has 3 apartments upstairs. When it snows, I ain't getting paid at the restaurant, but guess what? Her residents or tenants are paying her. And I made that connection. And I said, Mom, I want to get into the real estate. I went and bought a couple of duplexes up in Rochester by myself early 2008 because I thought it was a great investment. And they were. I mean, you buy duplexes, you pay 60 grand for duplexes. 5 years later, you sell them for 60 grand. But it was a great experience for me. Property management, learning to manage from afar. So all of that prepared me to meet Jake in 2009. And when he said he wanted to do multifamily, he was a pharmaceutical rep. He didn't know anything. He's not on the show. So I can honestly say that I taught him everything he knows, but honestly, if it wasn't for him, I wouldn't be here. And I think he could probably say the same, because I think partnerships can be terrible, but they can also be great. And I've been part of bad partnerships, and it wasn't just the partner that was bad. I was just as bad. I have to take responsibility for not fulfilling my duties, or for not even seeing that we're in the right match, the right fit. And, I have a lot of admiration for Jake. He's a hard worker. I mean, he was down here in Florida last week. He was working on vacation while he's down here visiting me. So it's just a testament to his will and to what, we've been able to build. And we met. Took us 18 months, like I said, to find that first deal. And since then, we've scaled up to, we own 1,700 units right now. We're closing on an 80-unit deal. And most of it's in-house. We don't syndicate as much as we used to. We've got 3 syndications. We went full cycle on 2. And it's been a great journey. And I just think real estate, that it's a vehicle, like you said, Matt, anybody can get into it. We're not born with becoming an entrepreneur. We're not born with all these skills. I think what helped me was to get surrounded by Jake, to meet other people in the space. Because when you're stuck in the kitchen washing dishes, that's all you know for all those years. That's your paradigm. As soon as you step out of the kitchen and you step into the light and see what other people are doing, it's like, wow, there's another world out here, and let me learn. And that's what I think propelled me to meet him, to learn. And those duplexes, I really credit those first journey out into doing those deals, and to give me the confidence to say, hey, I can buy 2 units. Why can't I buy 25 units?
Absolutely. So before we start talking about the first big deal you guys did together, that 25 unit, how did the Jake and Gino relationship start? Were you guys buddies, or what, just tell me about that?
Well, Jake was a pharmaceutical rep, and I had that restaurant, and Jake was catering orders out of the restaurant, bringing him to the doctor's offices. He was selling legal drugs.
Lunch and learns.
Yeah, exactly. Yeah. Legal drugs. Basically what it comes down to. He was good friends with my brother, because I'm the grumpy guy in the kitchen sitting like this. I'm pissed off, and that's who he thought. That's who he thought I was, and I was that guy. And I remember meeting him because my brother introduced him. It was one night they were doing a dinner out there. My brother's jumping around, having a good time, drinking wine with the doctors in the dining room, and I'm in the back cooking and washing dishes. So Jake walks in. I'm like, this guy looks pretty good. He's got a nice suit on, all professional, young guy. And we just start talking. We hit it off right there. And the thing that really stood out to me, Matt, was how prepared Jake was. Out of all of the pharmaceutical reps, they'd tell me, hey, Gino, I need an order tomorrow. Well, Jake would come in and he'd have his whole month laid out. He'd have his cardboard stock where he'd plan his week out. And he was really diligent with that. And he was a hard worker, something that, we both resonated with. And then when I heard that he wanted to create wealth, that he wanted to buy multifamily, that he wanted to do something entrepreneurial, I'm like, dude, let's do it. So from 2009 to 2011, we continued the relationship. We continued to get to know each other. And I think at the end of the day, it was all about values-based decision-making. Our values aligned, our goals aligned. We don't do anything other than multifamily. We don't buy crypto. We're not in the self-storage space. We really focus on multifamily, and we wanted to grow and buy and hold these assets. So all of those things were, I think, entailed and helped us build that partnership that we have today. And listen, if it didn't work after 2 or 3 deals, we could go our own separate ways. But I think Jake needed me. I needed him, and we each brought value to the relationship. We continue to bring value to the relationship to this day. And like I said, once he moved down to 2011, he was an economic deserter of New York. He was a lot smarter than me. He left a lot sooner than I did. I left in 2017, and he just got down to Knoxville, and he chose it. No state income tax, cost of living, quality of living. He just liked Knoxville, and thankfully he did. He planted his flag there, and like I said, it took us 18 months for that first deal.
Yeah. So digging a little bit on the partnership there, did you guys have a discussion this is what I bring to the table, this is what you bring to the table, this is going to be the roles and responsibilities for each of it? Or was it sort of kind of just a free for all starting out?
We weren't that smart. When we started out, it's like, bro, let's get a deal. That's the thing. I think people overthink it. And I think we're both massive action takers. When you're getting together with somebody, if you've got a little of experience, I would say, hey, this is what you do. This is what I do, and this is what we expect. On that first deal, Jake was boots on the ground, so I expected him to go tour the properties, to talk to the brokers. I would underwrite the deals. I would get my brother as a partner. If we needed any other equity, I would be able to source the other equity. And I understood the business at a much higher level than he did. So when we took the property over, he was property managing it. And he had, we were paying him a property management fee, and he was taking care of the property, doing, going out, collecting the rents, turning the units, and I was doing the bookkeeping. So obviously you need those expectations. And, at that time, we were just both working our W-2 jobs, but we had to dedicate X amount of hours per day per week to do this. And I think the important thing is that's why multifamily is great. Our first deal is 25 units. So you can still do your pharmaceutical job. I can still do my restaurant, and we can still manage 25 contiguous units at the same time. And then there will become a point in time where you have scaled up enough to say goodbye to the W-2 jobs. And that's what we ended up doing. But that first deal, it was a little tricky. We really didn't know what we were doing, but we did have our roles and our responsibilities. And as we grew, obviously he was able to hire property managers. I was able to get a bookkeeper, and we started just, I guess, scaling that way.
Okay. So 18 months took you to find that. How did this deal come across your radar?
Yeah. Well, the first, I think, aha, epiphany moment that we had in real estate, Jake was the sales guy. So he would go into these brokers' offices like a bull in a china shop, posturing up and thinking that he was when in reality, it's the complete opposite. You go to a broker and say, hey, Mr. or Mrs. Broker, I'm here. I'll do whatever you need. I am the person to close. You need to be selling that broker. And we were fortunate because back in 2013, deals were sitting on LoopNet. I mean, people have really short memories, and it's coming back. I think people just think, those days. It's called the market cycle. And that first deal that we found, obviously didn't piss off this one broker because he brought it to us. He actually, discussed it with us. It had seller financing on it. It was sitting on the market for 2 years. It was listed at $750,000, and we ended up closing at $600,000. We probably could have closed it for $550,000, but mom and pop, motivated seller financing. These are all things that we've done now in the last, 2 months, our last 2 deals that we closed. It's coming back. And that first deal was great, but it was a challenging deal. It was weekly renters. It was an older build, a lot of deferred maintenance, no systems, and we cut our teeth on it. We still own the property to this day. It's an amazing deal, but it's just one of those things that we finally ended up convincing a broker to take a chance on us. And that broker got our second deal. We got our third deal with the broker. That first deal creates momentum. So if you're out there and saying, I'm going to wait for that perfect property, if you can buy a fourplex, buy the fourplex, because then you're a closer. You have credibility. All of a sudden, people know that you've done a deal. That next deal, I guarantee you, is going to be a 10 unit or a 20 unit. So for us, that 25 unit with 3 partners, me, Jake, and my brother, Mark, if you think about it conceptually, that's an average of 8 units each. It wasn't that huge where we're going to go for the 100 units on the first thing. I always tell our students, think big, but don't worry about starting small. Just start.
100%. No, that's great advice. So was this an off-market deal? Or was this something that was sitting on LoopNet and you contacted the broker?
It was sitting on LoopNet, and the broker came to us, and we had talked, we actually went on LoopNet, called the broker up, and we had heard of the broker before, but just an older gentleman. And, when you're back down in Knoxville in 2010, 2011, with last names of Stenziano and Barbaro, things have changed a lot. 2 Italians in East Tennessee, that was a rare sight back then. But nowadays it's much more common. You got people from California moving to Tennessee, and that was what it was. It was all about building a rapport with the broker, letting him know that we were able to close this deal. Because like I said, 3 months later, he brought us another deal. Even though it was on LoopNet, he brought us the deal, and we were actually able to close that second deal as well.
Mm-hmm. So, all right. So they got this deal on your radar here, and then what was the order of operations? Did you go and see the property first? Did you ask for the financials first, and you did some preliminary underwriting? Tell me about that, all that pre-contract type of stuff.
Well, with mom and pops, the underwriting is you're not getting a nice T12, you're not getting rent rolls. It was a crap show, to say the least. But what you do is you go there, you verify that there's 26 units, you verify what rents are coming in, you verify what expenses they have. I mean, they were paying cable for these people, they were paying water bill for these people, they were paying the electric for. So we already understood the value adds. I understood, why are you paying $4,000 a year for garbage when it should be like $500 a year. So there's so many expenses that were out of whack. There's so much value adds. Although they were weekly renters, they were generating more rent per month by doing weekly than monthly. But there was so much turnover on this property. So we did go see it. We saw that there were garages there that were full of crap. We ended up cleaning them out and renting those out as well. So we understood the value add component. So when we're taking this deal down and we're going through due diligence, we verify the financial numbers. Right as soon as the financial numbers were verified, we were able to get an inspector through our broker. We inspected every single unit. We saw a lot of deferred maintenance. We're actually able to have the sellers replace a couple of roofs. They did some more painting around the stuff because they were motivated to sell, and we were able to negotiate that seller finance note. But that first deal, having a mentor, being able to, call the mentor up and say, hey, what's next? What's next? What's next? It really helped us out. And it's funny because Jake thought I was a genius. He's like, dude, where are you getting all this information from? Where's this document coming from? I'm like, bro, I got it. Don't worry. And then afterwards I told him, like, really? But it really helped because it's your very first big deal. You want to make sure you get the financials done. If the financials are not good, you don't even waste time with an inspector. But once we said the financials look good, we know how to add value, then you go with the physical inspection. And after the physical inspection is good, go with the legal, go with the title work, make sure there's certificates of occupancy, make sure there's no liens and all that stuff. And, I think the first deal took us about 60 days to close. We worked with their community bank. So the community bank that they had with their mortgage, we just actually ended up using them. That was one of the big mistakes. We just got on. It was a 20-year amortization. The rates were like 5.5%. We should have gotten a much lower rate, but they were giving us seller financing. And we understood that, hey, conceptually, we've never done a refinance, but we know in 18 months, if we fix this property up, we'll be able to refinance this loan and get it at a lower rate. So we're just thrilled that this community bank was willing to take a chance on 3 novices who never really did a deal in East Tennessee. So it's like, okay, 20-year AM, 5.5. We ended up refining it out to a 25-year AM, and the rate's like 3.5% at the time. So we knocked off a significant amount. We were able to refi out $180,000 out of the deal, and our payment really didn't go up because you could talk about a lower rate and a higher AM. So that's what with that deal. But like I said, when we closed that deal, I remember Jake going and knocking on all the units that day of close. And he's like, he saw some sketchy people, man, answering those doors, just to make sure that there are bodies in there, there are heartbeats in there. And that's how we collected rents for the first couple of months, believe it or not.
Oh, sweet. So, so tell me about the capital stack. You bought this thing at, you said 600. How much did the seller take back in terms of a mortgage?
If you'd asked me what a capital stack was back then, I would have no idea what the heck you're talking about. But back then it was 80% bank financing, 10% seller, and 10% for us. So I mean, $600,000. We need to come up with 60 grand. 10% each, but 33% each split in thirds. It was a total of like $85,000 with closing costs. So I needed to come up with 27 grand out of pocket, for a third of a deal. I had, asset was worth 600 grand. So that seller finance note, we still have that note. We're still paying this lady $300 a month with this note. And I actually talked to Jake last week. I'm like, Jake, is that note come due yet? He's like, lady hasn't said anything. She likes the money. So we can go out. I just probably like $35,000 or $40,000 left on the principal and that thing, but why pay it off? She's getting her $300 a month. She loves it.
Yeah. That's that could be a car payment. You know what I mean?
Yes.
So all right, so you got this, so 10% of your own equity, and then 10% seller financing, and then the rest was a community bank. And the community bank was okay with the second position mortgage and the seller carryback, right?
And the important thing was that they knew the property, they knew the performance of the property, and they knew that we're getting it at such a good price. It was like $25,000 a unit. I mean, like the replacement even back then was probably 75 to 80. So we're getting it at 1/3 of replacement. Plus I see the income. I mean, it was generating 13 grand a month back then on the income side. So they knew there was a lot. And, the sellers, when they sold out, they had so much equity in it anyway. So it was great. It was awesome. They loved it.
So, yeah, because that's one thing that I come into contact with is on seller carryback, second mortgages. The bank has concerns with the debt service coverage ratio and all that stuff. But it seems like there was enough meat on the bone with this deal that you could probably still maintain that
yes.
that DCSR. Okay. Cool,
yes.
Cool.
Yes.
All right. So excellent. So did you guys put your own 60 grand into this, or did you raise it, or tell me about that?
No, it was just us. No, it was us. It was my brother, Mark, me and Jake. We each had the money. We each put it in there. And I mean, if you think about it, if I had a 401k, I would have blown it up. I had some whole life insurance. I had cash value in the whole life insurance. I have a mom. Jake on his third deal hit up his grandma. You do whatever you can for deals like this. They're like legacy deals. You do whatever you can. And I always tell the students, and I think I explained this to my wife, and I think she finally understood real estate, multifamily, and I guess savings. We're taught to save for an event. I was always taught to save for retirement. I was taught to save for college education. And my paradigm shifted when I said to myself, I need to save to buy an asset to pay for that event. Mm-hmm. And ironically enough, this first deal, it throws off about between $8,000 and $9,000 of cash flow per month since about 2016, because rents were $350 back then. Rents are over $1,000 now. So if you think about it, you take a third of $9,000, I'm getting $3,000 a month in cash flow every month. That's paying my kids' college. My first daughter, 4 years, she graduated. My son, he's going to be a senior this year. He's going to graduate. My next child, 3. So if you think of that one asset that's paying for college, now if I had put $100,000 into, or even the $30,000 into a 529 plan, that money would have evaporated after maybe a year and a half, and that would have been gone. So I think that the big shift that I think we have to teach people is to save to buy an asset that'll pay for those events. Because I continue to own this asset. I've had cost segregation on it. I'm getting principal pay down. I'm getting appreciation on it, and I'm getting cash flow on it. And that you can't really say that about buying stocks or about buying crypto. And I think if you can shift that mindset to, no, let's not save just to buy and, for this retirement. Because when we retire, we don't have a net worth problem. We have a cash flow problem. You can have a net worth of $3 or $4 million, but is that throwing off any kind of cash flow? Well, if you have some kind of assets like real estate that are actually providing dividends for you every month, I think that's really important. So that was that learning, that paradigm that I had. I'm like, I got to go in full on this real estate thing. This totally makes sense to me. And then refining the money out, you're basically making a loan to yourself and you're taking out $180,000. I don't know about you, Matt, but I got to make a lot of pizzas for $180,000 to make a profit. That's like thousands of pizzas. So you can do it on one refi and you're netting that money. It was just complete game changer for me.
Mm-hmm. Yeah, I mean, I was a Robert Kiyosaki sycophant. When I graduated college, I was like, okay, if I want to get a liability, I got to get an asset to pay for that liability. So, the first place I bought was a 4-family property. Owner occupied it. I limited the liability of rent.
Oh yeah.
The second one that I bought, that I moved into, had a slightly larger unit because I was shacking up with a roommate in a 1-bedroom apartment. I lived in the attic. Okay. And this wasn't like this wasn't really a finished attic. This was like the old servants' quarters.
Yes.
You typically see it,
Yes.
And so, and then those 2 properties that cash flowed, my wife was like, we got to buy a house. We got to get out of this apartment. And I dragged my feet the whole time. I was like, okay, we can buy a house as long as the cash flow from these 2 properties pays the mortgage and taxes, insurance for the other one. So I kind of used this like leapfrog thing. Fast forward, I wanted to buy my wife's retirement. So I bought a property to pay for my wife's retirement. I bought a property to pay for my daughter's college education. So, those like stacking all those things together, then at the end of the day, you're like, wow, like I'm I have all these things that people worry their entire life and then they're squirreling money away in a savings account. And then also you got, I don't know, I talk about this a lot, like retirees in this country are screwed because we have this asset allocation thing that happens, right? You have predominantly your retirement in equities that don't cash flow that much. And then when you start to asset allocate into income producing investments, even like, your corporate investment grade bond funds are paying like 5%. And so it's just like, that's why I'm always like, evangelical about the real estate, about real estate. And like, nobody talks about it. It's like, listen, you can structure in a way where you don't even have to pay income tax if you're doing it the right way. So, you can eliminate that liability as well. So, but that's awesome. So let's bring this a step forward. So you close this deal. Jake is out there, collecting cash from these people on a weekly basis. Kind of tell me from what kind of happened from when you closed until kind of now with that property.
Sure, but before I answer that question, I love what you said. You have all these different assets, and they're like little cash machines. They're like little mini businesses. I think that's the way you should look at them. Each one is producing income. You have one here, you have one here, and you have them allocated. We call them baby money soldiers. Your baby money soldiers, they're replicating, right? You're not just spending them for expenses. You're not just buying luxuries with them. You're letting them procreate. And as once you can understand that, and you can take that money and you can let that reproduce, that refined roll is a great way to reproduce those baby money soldiers. And the other thing is, with baby money soldiers, you don't want them all out there. You need to keep some in reserve. So that's what you're doing as well. So you need to have savings. I'm not saying not to, but you need to have those savings go out and conquer more properties. Now, what happened with us, I remember the first time he had collected that cash, he said it smelled like Marlboro cigarettes. He puts it on his desk and he's all laid out and he's taking pictures. And I think that's when it shifted for him, because he had never had anyone pay him. Right. I always had that small business. So I was always used to people coming in the restaurant, and I had that small business mentality, but he was a W-2 worker. He never had that. And I think when that happened, man, he was completely hooked. That just changed everything for him. He was looking for that next deal. What we ended up having to do was, reposition that property, turning it over from weekly renters into monthly renters. Because it's just amazing that you can charge somebody $150 a week, which is $600 a month. They'd rather pay $150 a week than pay $400 at the end of the month, because they're living week to week. It's just mind-boggling, the financial intelligence that's lacking. And I guess it's just the people have that instant gratification where they're not really good with their money. That's just an excuse. They've never been taught. But that was very difficult, because we had renters in there that were suing us for bed bugs. And meanwhile, it's their furniture and it's their beds. I couldn't figure that one out, right? Our septic fields fail after 6 months. Thankfully, it was a $9,000 bill that cash flow was able to fix. We had a lady who passed away in one of the units. We called her the smelly lady, because you go into the apartment, it was just awful to smell. But that was a really difficult one. Can you imagine on your first property, we have a resident that passes away? We didn't know what to do. We had to call the attorneys and all that. Was a challenging thing. So I'm just throwing all the bad stuff out, because it wasn't all sunshine and rainbows. And yet we still said, hey, this thing is great, because at the restaurant, I'm dealing with things daily. These things may pop up every couple of weeks. So for us, it took us a good 6 months to reposition all the tenants, get it out from weekly to monthly, have an application process, hire the resident manager who lived on site, who was able to be there, open up the apartments when we had to do a turn, show some units. So we had that going on as well. But in between that, the second deal comes on. And what was really interesting about that one, we still partnered, the three of us, but I found my partner, Mike, who was a strong balance sheet. I found him at the restaurant. He was a customer at the restaurant. And one day I'm sitting in the restaurant in the front. I've got my shirt on, the pizza sauce. I'm all dirty. In walks Mike, nice Bruno Maggi shoes. Didn't know what Mike did at the time. So he sits down, he's taking out some food, and we start talking. And I don't think he knew that I knew about China and oil and gold. He's a hedge fund trader. So we just start talking. And I find out that he's buying single family homes up in Westchester County that are just, the prices are astronomical. And I just told him I bought a 25 unit and I'm, producing $13,000 a month in rent. He's like, wait, I just bought a $2 million home and I'm getting 10 grand a month. And you've got a $600,000 asset that's producing 13,000. Tell me more. And that's what the thing is. Was that lucky? I think it was lucky, but it was also, I was prepared to have that conversation. I had that first deal. Even if it was a fourplex, it still would have interested Mike. And from then on, we partnered on that second deal with Mike. And another thing, if it wasn't for Mike, I probably wouldn't be here. I'd have to find another Mike, because he was the balance sheet person for the first few deals. He had the net worth. He had the liquidity. On our third deal, Mike lent us $500,000 as part of the down payment. He actually diluted himself 500 grand. We gave him 5% on his money, but when we refied him out, we paid him back his 500 grand, because he saw the potential with this. He's like, I can't believe you guys are buying these at these prices, these price points. Mike needed real estate. He needed me and Jake, but we also needed Mike for that part of the business. And that's what was great about it. He had a business mind. He understood that real estate is income over expenses. It's NOI and it's debt. And I think he helped us understand that part. And he helped us understand that real estate is not just collecting assets. It's really a business. And from that point on, we just kept buying assets from that point on.
Yeah. So before we wrap up the recorded section of the show here, I want to kind of go into that a little bit, because, a lot of my students are, this is the first time they're raising capital to buy larger deals. A lot of them have kind of bootstrapped it or done hard money, borrowed hard money to buy deals that had equity in it already. So how did you structure that, that partnership? Because it, sounded like Mike was, bringing some capital to the table. Maybe he was a personal guarantor on the debt. Maybe he wasn't. Can you kind of give me some color on
Great
that?
question. Yeah, for us, it was really pro rata. Mike, you're bringing 45% of the equity, you get 45%. Now, on that third deal, Jake had no money. Grandma was tapped out. We gave him a 2% acquisition fee. So on a $4 million deal, he had $80,000 of equity, which he rolled into it and put some other money. So he got 20% on that third deal. I've got 35%, and I think Mike is 40 or 45%, which makes 100. But, pro rata guarantors based on, we actually did a third each. And then going forward, by the fourth and fifth deal, we were able to actually start refining these deals, the deals that we had. So we were actually able to pull out capital and go forward. And then obviously we didn't have the liquidity requirements, and we didn't have the net worth to get those bigger Fannie and Freddies by year 3 and 4. Mike was actually able to say, hey, you know what? You've got my balance sheet. So he didn't charge us, but we were able to put up equity as far as pro rata. You can get as creative as you want on these things, depending on if you're the boots on the ground, you're managing the assets, and you have a person who's pretty much passive. I mean, that I wouldn't say 50-50 equity. I would say the person doing all that work, taking all that responsibility, may get a little bit more equity if he puts in a little less capital. But at the same time, be cognizant that you need that money person. You need that KP and all, and you're taking risk, but he's also taking risk, because if the deal goes bad, he or she is signing on that debt. So I think you have to be cognizant of that. And I would never raise capital unless I have a clear business plan, unless I understand the business at a level. And for us, we didn't raise money until we had about 800 units. We did our first syndication. Now, was that right or wrong? We probably should have done it sooner. We were just comfortable with how we were building. We look back and we wanted to be the Chick-fil-A's of the apartment world, not only from customer service, right, but from the infrastructure. We didn't want to outgrow our infrastructure. We didn't want to all of a sudden have 1,000 units, and we don't know how to manage these things. We didn't want to be able to not manage our investors. You see what happened in Houston with one of those investors. He grew, over 8,000 units in 3 years. Now, that's massive. I mean, I didn't want that to happen to me, and I really took that responsibility of being a fiduciary for other people's money really seriously. And I wanted to know what I was doing. I wanted to have the systems dialed in. And I think we had enough capital to grow. And we had the business plan of buying those assets, putting them on what we call our conveyor belt, letting that equity matriculate, exiting them, and just repurposing that capital into the next deal.
Sweet. This has been awesome, Gino. Any last words of advice, or how can people find you?
I like the name Andrew. If you're going to pick a name for a boy, I think Andrew is a great name. Go to jakeandgino.com/webinar. We just had a webinar last night live, and every month we put on a new webinar. Last night was about debt and what's going on with creative financing, what's going on in the financing world. We talk about the current market. So just go to jakeandgino.com/webinar and just sign up for next month's webinar and watch the previous month's webinar.
Absolutely. Sign up, folks. If you want to go big, you got to get obsessed. Because if you're in the single family and small multifamily space, and you're surrounding yourself with single and small multifamily people, and you're not exposing yourself to new ideas and really marinating your brain in that stuff, like it's going to always feel foreign. It's always going to feel foreign to you. So definitely sign up. I know I'm signing up. Well, Gino, thanks so much for coming on. For those of you listening on the recorded side here, if you want to get a chance to ask live Q&A questions to guests like Gino Barbaro, you got to join the Facebook Go Big Live Real Estate Investors Group. It's Go Big with an exclamation point on it. I think it's the only Go Big with an exclamation point on it on Facebook, and join our community. So thank you very much, Gino. We're going to go into Q&A. See you guys later, people.
Thanks, Matt.